All right, welcome to the video today, and I wanted to go over something about making the decision once and for all that you're going to play and get to the top of the food chain. And I like to call this the wealth decision. It's very important and it's vital for everybody. A lot of times we don't have the right information about the right data about what it takes to really be wealthy. I'm not talking about rich, I'm talking about wealthy. So I wanted to share and show this with you why this is important because can we see it? We can see it. Now, right away, I like to use this pyramid or triangle. So this here and here. So this top right here, this is wealthy. This is the wealthy part. This is the lower income piece. This is your middle class. This is the middle class. This is the upper middle. Stick with me on this. This is the wealthy. This is that wealthy class. So most people are right here. Most people are trapped in the middle. The problem with being in the middle class and the upper middle class is because that is quote unquote rich. That's the successful. That's the thing that we've all heard and we've all been taught that this is the place where you want to be. Most people, and if you don't know this right now, but the middle class and the upper middle class is the new lower class because as you take a look at what's happening in the world right now with the capital markets, the debt market, interest rates are high, the Federal Reserve, inflation is the number one killer to all people's incomes, cash, everything. It raises values on products. So that way the buying power of your dollar is less. So it doesn't matter how much money you make if the prices of products, services, all the things that are going on in America right now are constantly going around the world are going up. Your dollar can't keep up with inflation. So as the middle and upper and middle class people who make anywhere from 50,000 to 200,000 and above, 200,000 or so, right in that 250, as these people's incomes and net worth does not change because they're locked in, right? If the inflation continues to go up, their dollar buys less. So they got to slip down. Now, the people in the lower income class, they're okay. They're getting assistance. We'll just carve this out. Not that that's not important because everybody needs it. I started off with nothing. A lot of families start off with nothing. But there's a reason why I'm crossing this out because I'm usually having conversations with these people who think they're here, but really they're here. And think through that. So if you make, let's say you make $100,000. Now, let's say you make $200,000. Let's say you're there. You make $200,000. If you're in the middle class and or the upper middle class right now, you're probably paying about 40% in taxes right off the bat. So no matter what, you're already losing what's that 80K in taxes before you touch anything. That's just federal income tax. Let's say you're in California or a place that you have state income taxes. It's closer to 50,000, 50%, right? Or it's closer to 50% taxes than 40%. But let's just play with 40%. So you have $120,000 left over. That's before you pay for gas, mortgage, house, insurance, take your kids to school, buy clothes, anything like that. So this right here is what people are playing with no matter what. And if you take a look at the average mortgage across the United States right now, the average mortgage across the United States is around about $3,000. And that's a mortgage if you have a good mortgage. Rent across the United States right now is somewhere around $1,900 to $2,000, the average. But if you live in California, like we do, or Hawaii, or Washington, or any place where it's nice right now, right? Your average rent or your average mortgage in there is closer to about $5,000. So you have $5,000 times 12 months. You're already at $60,000 for the year. Half of this is already gone. So now you're at $60,000. Again, we're just talking mortgage and rent. We're not talking anything else. The rest of this money is going to be blown on what insurance is up right now. Life insurance, car loans, credit card debt, because a lot of people have credit card debt, student loans. They're talking about trying to get rid of it. That's not going to solve the problem. The problem is moving from this to the wealthy. This is where it's at. And the reason why I say that this is more important than focusing on like, okay, what do we do to kind of like, how do we save more money? It's not about saving more money. You need to get into the investment side of what you're doing. If you're in the upper middle class, if you're in the upper or middle class, you need to be trying to make the decision once and for all that you're going to become wealthy or you're going to start playing the wealth game. Here's why. In the middle class, these are stats. You can look them up on Google. Right now, there's $37 trillion in retirement accounts. There's $6 trillion in money market accounts, in the money markets. Right? There's roughly about $900 billion in personal savings in banks. Personal savings in banks. What does that tell you? People are scared. They're saving money. They're not investing money. That is very, very different. Even in a money market account, if your money's in a retirement account, you're just offsetting taxes. You're saying, okay, fine, I'm not going to pay tax on my money later. I'm going to put it here. And then later, you're going to receive that money. You're probably going to end up paying taxes on it. Or if you're not paying taxes on that money when it comes out, it's going to push you into a higher tax bracket because you're going to receive it as income, period. It's going to rise you up. And how many of you guys think when you retire later, and they're talking about moving the retirement age in the Social Security to 67. I bet, I'm 50 right now, that by the time I'm 65, retirement age will be 70. Remember that. But that said, how many of you guys think that by the time you retire, if you're in your 30s or 40s, that taxes will be higher? 100%. I believe it's going to be higher because they're going to print more money. So to print more money, they're going to have to raise taxes to pay down that debt. So that's there. If you've received any type of financial win from all your upsides or in the stock market, money markets, all that other stuff, when you take your gain, that's going to be taxed as well, right? Because that's going to be, it's taxed as an ordinary income. So you're only probably getting about half of it. If you make 4% on your money in some money market account or a CD or the stock market or whatever it is that you're doing, and it's not backed by some real estate where you can offset the tax ramifications on that, if you're getting 4, you're getting 2 because you're going to get taxed. Why? What I shared earlier, I'm sorry, guys, I get excited about this stuff, is because, boom, depending on whether you're a big shot or not, you're going to get hit with about 40 to 50% in taxes because it's an income, right? So that's there. If you got money sitting in savings, in my lifetime, I was born in 1973. The value of a dollar has went down by 86%. Just from, I think, 2020, the value of the dollar went down by 20%. So if you have $1 million sitting in the bank today from 2020 by itself, your $1 million really only has a buying power of $800,000. You've lost 200 grand. That's crazy. So that said, that's why I talk about all the time, guys. It's so important. Once you make a decision to go here, then your decisions of where to put your money start to change. Like I said, and I just wanted to kind of share that. When you think about that, $37 trillion sitting in IRAs and 401ks. Most people have their money sitting there because looking back on what IRA accounts and retirement accounts, 401ks were set up for, they were really a product of Wall Street. And they work with Wall Street and the IRS and financial advisors, and like, hey, all these financial people who came around at that time, they're like, hey, let's do this. Let's create a financial vehicle. Let's have people put their money into it. Let's have them leave their money in there, and let's now bring it into Wall Street, and we'll bundle it up and we'll sell it off as a security. We'll put it into mutual funds, mutualized funds that have a bunch of different stuff in it. You don't even know what it is. Sounds good though. Index funds, growth funds, all these different things. And as long as they get you to trade, that's where they get their fees. And you may or may not have your retirement money later. You need to be responsible for that, where you're going, if you're going to make a decision to be wealthy. Throwing your money in the money market account is the same thing with this. They take your money like these bigger institutions, Vanguard, BlackRock. Nothing wrong with them. I love them. They're models. I study their companies. But you take your retirement money, when they deal with pension funds, sovereign funds, endowments, all that stuff, and they move all that money, firemen, pension funds, police, teachers, everybody, into money market accounts. And they trade this money over and over and over and over and over again, waiting for you to retire, because they know everybody's not going to retire at one time, in hopes to have enough gain and minimize enough losses, which you cannot do and they can't do it either. They make trades. If they lose, they keep on going, right? You can't outpace that. Your personal savings, also a bank product. The banks came up with a way to, hey, look, let's have people put their money in a savings account, leave it there, don't touch it. If they get touched, we tell them they're going to lose a piece of it. So leave it there for a certain amount of time. And oh, by the way, we're not going to pay you anything, but we get to lend your money out 9, 10 times, right? That's what goes on when you leave your money at the bank. So you can actually be in charge of this by taking your own money. And with this one, you can move it over. We can help you do that if you want. You can invest with us, whatever. But you need to move your money to a self-directed IRA, and then you can take that money and you can invest your own money. You can say, hey, I want to self-direct. I want to move my money into real estate where I get cash flow, appreciation, or future appreciation. I get all the benefits of that. And that money goes back into your IRA. Move it out of the money market accounts. The markets are going up and down right now. The whole thing is really the S&P 500 is held up by 7 companies. That's called the Magnificent Seven. 7 companies are controlling everything right now. AI is pumping. They're all in this AI race. So you don't know what's going to happen. Wall Street wasn't designed for the little guy. It was designed for the big guys who can roll up all this money, throw it in, and then it gets traded over and over again. And it just keeps up and down, up and down. You know, unless you're monitoring that, great. I'm not talking about dabbling day traders. I'm talking about putting your money in a place where you don't have to worry about what's happening, and which is real estate, the type of real estate we look at. And you can do that. Then same thing with this is not investing. Saving is not investing. You will not get to the top of the food chain being wealthy. Everybody that all wealthy, the top, really it's the top 1%, but let's just say 10%. This top 10% owns 75% of the wealth in the world, because the wealthy own top 10%. The top 10% own 75% of the wealth. Now, here's what's weird. This is the largest group. You guys get taxed the most. Now, I'll put it down so we can see it. I like to write stuff down. Hopefully, I'm not too intense, but man, I really hope this helps somebody understand. So if you're in the middle, you get highest taxes, highest tax. You get sold retirement accounts, which is a product of Wall Street. You get sold, leave your money in banks, right? That's the savings, which is another product. Oh, I left this one off too. Mortgages, home mortgage for homes. That's also a bank product, right? This happened was when everybody got back in 1945, as a matter of fact, maybe a little earlier than that. Banks figured out, hey, we will go ahead and we will create a product and we will say everybody should own their own home. That was a marketing strategy. Look, everyone needs to put their money away and save for retirement. Again, a marketing strategy. Everyone needs to put their money in the bank and save money. Don't spend money, save your money. Bring it to Wells Fargo, bring it to Bank of America, bring it to Citibank, bring it to Chase. These were products that were designed not for you guys, but for them. And unfortunately, there were great marketing plans and we all bought them. But when you get the right information, these were not designed, like I said, and this right here is for federal government, it's for the IRS, it's for everything. But this wasn't designed to help the middle class. This was designed to help the banks. It was designed to help Wall Street. It was designed to help the SEC. Like it was designed to, well, the SEC is kind of in partnership with all these people. But this was designed not to help you get out of the middle class. This was designed to help keep you stuck. Why? Because the people who have these as products, right? This is that 40% in taxes. These are the people who are stuck, but you can get out. All right. So the reason why I think this is important, because in this group, like I was talking about, the middle and upper middle, who's in it? This is the entrepreneurs. This is the business owners. This is the people who went to college, the doctors, the attorneys, the engineers, the highly educated, people who went to college, people who also got sold that other program that started off, which are universities. I forgot to do that one. College for a degree. We'll finance it. We'll finance it for the rest of your life and it will not go away, just like taxes. They're trying to get it to go away, but man, it's not. It's there. The moment you graduate with $100,000 college debt, 80 grand college debt, even if it's only $20,000 college debt, it doesn't go away. So the day you graduate from college, the juice is running. So your first paycheck from your first job also needs to go towards, at some point, college debt. So it's there. It's all of that. Like I said, and the way to get out, the reason why that's important is because we talk about, if you're in this piece, you're a part of that group. College, you went to college, you got a degree, or you didn't go to college. Let's say you're an entrepreneur. You're here, you're making a little bit of money, not enough to push forward. So you're pumping, you got a family, you got a house, you got a car. Let's say you have employees. And you know, the middle class, we also have those middle class and we call them middle class millionaires. Middle class millionaires. That's the entrepreneur who has a lot of my buddies are in that place. They got millions of dollars worth of assets. They have a great house, multiple like exotic sports cars, all this other stuff, but they are not wealthy. If they stop today, they're done. Even if their businesses continue on going, I think maybe most of anybody that's a middle class millionaire, if they die today, their companies will go on maybe about 2 years after that and be done. And I know that's true because only I think it was like I want to say 1 out of 9 of every business. When Google this and refer this, I talk about this. Only 1 of 9 of every business makes over $1 million of revenue a year. That's out of all the businesses. There's what 30 million businesses in the United States, small businesses, and only 1 out of 9 of them, maybe 2 out of 10. Well, it was like 1 out of 10, right? Which makes it like 1. But basically 10 to 20% of them, less than 10% of all businesses in the United States makes over $1 million worth of revenue. So you're automatically here. And if you have a business, you're still getting taxed at this rate, depending on what state you're in. It doesn't matter whether it's personal or it's business. Depending on the business that you're in, this is where you are. Even if you write it all off. Because I got a lot of business guys that'll have a business, they make a lot of money, but they write it all off so they don't make any money on their taxes. But then how do you get anything else? Is you're constantly robbing Peter to pay Paul in the company. That is being a upper middle or a middle class business owner, like them, or a middle class millionaire. You have a couple of properties, but the moment something happens, you lose them all. So now you're back to zero right here, scrambling and pumping. So how do you fix that? I know I went over a lot. I'm sorry. I get pumped up about this stuff because this is so important to me. This is why I created Bell Capital. Number 1, you need to invest. You need to invest money. This moves away from saving. Saving money does not make you financially free. Savers are for losers. Investors are for wealthy winners. That is always how it's going to be. So number 1 thing you need to do is you need to invest money. You need to invest something that has cash flow. Cash flow. It needs to be an asset. All assets have cash flow, right? That's very important to understand. It has debt and it typically has some form of cash flow associated with it. So you need to invest money. So you need to invest in cash flow. It needs cash flow. The possibility of future appreciation. I'll just stick to there. The future appreciation. It has to have some growth potential in it. Typically, in income producing assets like we look at multifamily that we go for in Bell Capital, the cash flow continues to go up. So that is where the valuation of the property comes from. So as long as the cash flow is able to be increased, then the value of the property is increased. It's not like a single family house. We're talking commercial real estate. Very different. All right, next, it needs to have tax benefits. This is the game of the wealthy. Look, you want to make cash flow and pay no taxes. And possibly later when you have a windfall, you have an event. It's called a capital event where you actually make money on your investments like we do. Like say, because in the past we had investors, we sold them out of those things. You can 1031 exchange, or you can roll that money into something else, or while you're getting paid. Because real estate, the commercial real estate has tax benefits to go with it. You have depreciation, you have accelerated depreciation. That all gets passed through to our partners. And now you may pay no taxes, depending on your situation, on the cash flow that you received this whole time. So it's almost like if we gave you, let's say you made 5% on your money. That's the equivalent of making like an additional 2%. So it's almost like getting 7%. Because if you got 5% and it cost you 40% of that, right? That's another, you're losing 20%. So to do something without getting taxed, it's like getting another 2% over, right? What's why I said, if I give you 5% on your money and it's not taxed, it's like giving you 7%, as opposed to giving you 5% that gets taxed. It's really like giving you 3%. So this is the game of the wealthy. The wealthy all know this. And here's the other thing. You can do it at scale. They are not playing the onesie-twosie games. If you invest your money, let's say in Bell Capital, we're looking at a 200-unit apartment building. That's scale, right? So that's diversification. They're not all over the place. They're not playing this and that and this and that stocks. And we have Bitcoin and now we're playing into gold. And now we're doing a little bit more money in our retirement account. That's fine if you want to stay in the middle class or you're a middle class millionaire. I'm talking about people who want to play the wealthy game. They're like, look, how do we get scale? We're going to go all in on this asset class. We're going to take our money, we're going to invest it, and we're going to wait, and we're going to be patient. We're going to collect cash flow while we wait. We know we have a future appreciation coming, even if that future appreciation is 10 years. Wealthy people play a long game, right? They know they got the tax benefits, so they're keeping more of what they got, and they're playing the game at scale. They're not buying one house, and they're not buying a fourplex or a 5-unit deal. They're investing their money with somebody, an operator like me, who's like, hey, we're going to go and we're going to buy 1,000 units this year. We're going to buy 1,000 units next year. Every time you get money, you can invest that money, right? As long as you're qualified. So, and the other thing that is important, I know this video is long, but this is important. You should watch this, share this with your friends. Another thing, when they're thinking about investing money, they're looking at something that has inflation. An inflation hedge. Real estate is an inflation hedge. Why? Because if we invest in an apartment building, right, or we take our money, we push it all into an apartment building, we're preserving capital, right? Which that's for something else, but we've preserved our capital. But while it's there, because rents have a natural lift, rents continue to go up in this country since 1945, the last 4 decades. People don't talk about this a lot, but rents in this country over the last 40 years has went up on the average 9%. If you go to Google and you look that up, it's average over 9%. It did better than the S&P 500. But that means that it's keeping up with inflation. And when we look at any deal, we're like, hey, we're not talking about what happened from like 2019 up until last year, 2023 or so. That was a crazy time. Rents in this country went up like by 25%. That's not normal. The normal is 8%, somewhere in there. And if we just budget, when we're taking a look at any deal, I'm always budgeting 3%, 5% rental increases per year. Not even when I get it, but let's say in year 1 and 2, we start budgeting then. We need to get what we get in the beginning. So because we understand we're looking to keep up with inflation, right? Because naturally I'm super conservative with my numbers. But when you're investing, you're thinking about being wealthy. One, they're investors. They're not savers. They know what they're investing in, right? Real estate is very simple, which is why I'm talking about real estate with you guys. Business size, commercial, institutional quality real estate, multifamily real estate, where people need a place to live. Really nice, great locations, sick locations, great cities. So this is another thing. But long as you can hedge for inflation, where your dollar is not being beat to death by, this phantom tax called inflation. So that, last but not least, right, is hard to disrupt. Real estate itself is hard to disrupt. It's not like AI and tech and the Mag 7, where today, literally, I can go on CNBC right now. There could be a scandal, which there was. I think AI had some scandal that came out with like Scarlett Johansson or something like that. And all of a sudden the stock went down. Salesforce lost 20% or 30%, like overnight. Just boom, like that. So if you had money invested in Salesforce as it relates to as a stock is concerned, your value of your stock, your shares, the money you had went away. It was easily disrupted. That was disrupted by media. It wasn't even disrupted by something real. You woke up the next day and 20% of your assets went away. If you had all your money stacked over there, that's crazy. So that said, wealthy people don't do that. They look for real assets, real locations, something that's very hard to disrupt. It's an inflation hedge for their money. So their value of their money is actually rising with inflation. It's keeping ahead of inflation. They can do something at scale. They're not investing in one house, one business. They're investing in 100 units, 200 units at one time, right? They know where their money is. They have the tax benefits because the value, the asset that they're investing in has it. They have potential future appreciation. This value of the property is probably going to go up. And because inflation is the way that it is, you want your money in real assets. You don't want your money in paper assets, stocks, dividend, like stock don't, a lot of them don't pay dividends. You want something that's tangible, something real, like real estate. And it pays you cash flow while you wait for for the future appreciation. You get the benefits of this. You become an actual investor. That is the only way. There is no other, I'm telling you guys, there's no other way to get to the top of the food chain. No, you can work your ass off. As a matter of fact, these guys, as income is related, if they work, this bracket of income kind of pushes up to maybe about $400,000 to $500,000. $400,000 and $500,000. And remember, if they're working and it's an earned income or an ordinary income, they are getting taxed at 40%, sometimes 50%, depending on where they live. Even if they live in a place where there's no state tax, they're getting hit with property taxes, high insurance costs, all that other stuff. It just is what it is. But I've said that to say, even the people at the top, from an income perspective, they still take what's remaining from their income and they invest it in real assets, which continue to keep them up. So if you want to get at the top of the food chain, if you're going to make this decision, play this back. Remember what I'm sharing with you guys. You need to think through where you are. If you're here, great. Middle class, you know you're here, right? $50,000, maybe 100, maybe 200, $250,000. You're kind of tinkering here. Even a combined household income, right? You're here. You need to be here. This is the only way to survive in the world. This ensures survival generational for you and your family, period, right? You're going to be doing what I said here. The way to get to the top, the decision you have to make for yourself right away. Number one, stop saving money and invest it. Take your money out of the banks, take your money out of your retirement accounts, and you move it over and you invest it in real assets. Got to have cash flow, got to have potential future appreciation. It's got to have tax benefits associated with it. The investment has to have some scale. You do not need to invest in a 4-unit, 5-unit, 6-unit apartment building deal. Invest in something larger, 100 things that we're looking at. You have questions, go to bell-capital.com, hit invest now or get started, and go ahead and register your account. Take a look at what we're doing. All right. And if you have questions, reach out to us. We're here to help. And you also want to have something that you put your money where it's an inflation hedge. It's hedged against inflation. It continues to rise as inflation continues to rise. Because again, I said it earlier, how many of you guys think that they are going to print more money in your lifetime? They 1000% will. There's no way they're not going to print any more money. They're going to continue to print. They got to do that. It keeps the economy moving. That said, the more money gets pumped into the population, the cost of goods will continue to go up no matter what kind of monetary policy the Fed's put in place. Value of assets will continue to go up as long as people have more money to spend. Last but not least, they put the wealthy. If you're going to be wealthy, you're going to put your money into something that's hard to disrupt. It can't be this new fad. Real estate, like business level real estate, we look at works because it's a proven asset class. All the times of Jesus, even before Jesus was around, people were always investing in land. Now it's people invest in income producing properties, income producing cash flow properties, great real estate, great pieces of assets, great locations. But I hope this helps you guys. And this is important because I wanted to share all of these things with you guys because I was having this conversation. We were talking about making a decision to become wealthy and what that actually is and why it's so important. And the information that we've all got was to get here. Hey, maybe you didn't have that much when you started and you wanted to get here. Or better yet, maybe you came from a great middle-class family like I did. And I was like, oh yeah, this is the game. I wanted to get to upper middle class. I wanted the cars. I wanted the beachfront house, which I got that stuff. Be careful what you wish for. I had a business. I was making money, but I was rich, but I wasn't wealthy because I didn't really know what wealthy was until I started studying hedge fund guys, private equity guys. And I'm just looking at the guys, but when I say guys, I'm talking about companies, Blackstone, BlackRock, Vanguard, State Street. Start looking at what these companies are doing, and then start looking at the investors of their companies. Those guys actually deal with pension funds, life insurance companies, things like that. I'm dealing with everyday people. I'm dealing with this group because I want to help us all get wealthy. I'm going after these same assets the wealthy buy, but I'm offering it to these guys. The people in the wealthy, these wealthy companies and firms, I'm talking about $1 trillion companies, not just $1 billion people. They aren't offering what they do to the middle class and the upper middle class. They're not doing it. They're feeding this level. So what we're doing is because I'm one of you guys. I'm a working middle class business owner. I pump, right? But Bell Capital is being designed so we can actually help the everyday investor like you guys get here. This is where we're going, period. We're buying the same assets they do, but we're offering it to this group. We're not just keeping it way up here. Like, I don't want to do that. That's not who I am. That's not what I want to build. So I want to do it with you guys. That's what we're doing. No one else is doing this the way that we're doing it here in San Diego, here in Hawaii, on the West Coast. Everybody's pumped out to like the Southeast, Miami, all that stuff. I don't want to be there right now. This is for this. I know 100% this market is going to explode over the next decade. And I want to do that with all of you guys. So again, this is really put together because I want to help you guys make the decision to be wealthy once and for all, right? I know this is long, but this is so important. If you get nothing else from this, make a 100% decision that you're going to move yourself from here, even if you're here. Let's say you're lower. I started off here, and we all start off here. We start off with nothing, and we move our way up. But if you're going to be starting off lower, just make this the target. If you're here, make this the target. If you're already up here, make this the target. Make these commitments. It's very simple. Invest your money. Don't save money. Put it into something that works. We're here for you. I created something because I wanted to help you guys. That's what Bell Capital is. I'm offering you guys to invest with us at Bell Capital into the assets we're doing. And every step of the way, I want to educate you guys on what it really means to be an actual investor. You don't have to do this yourself. As a matter of fact, I would tell you, don't go do it yourself. Invest your money and stick to doing what you're doing to make money right now and keep throwing money down in these deals. And before you know it, you will be the 1% if you're not already. All right. So like this video, share this video, comment on this video if you have a comment. Well, I'd love to hear your comments and your feedback. If you have questions, I'm here for you. Go to bell-capital.com. Click schedule a call with myself or my team. We can answer any questions you got. It's a 5-minute call. If you're interested in investing, you can go to bell-capital.com. Hit that link that's there that says get started or invest now. Register your account. You can take a look at the open fund we got, take a look at the deal that's available, and we want to have you there. But first off, we're here to help you and we're here to answer your questions, and I want to talk to you. All right, so if you need anything, reach out. Let's go.